Welcome back to Be Rich. After Namakkal, my team decided to do an event in Vellore. We have familial connections with Vellore. My father went to college in Vellore. He attended the Wooders College. So we are doing an event in Vellore on the 20th and 21st of July. Those desirous of attending this event should contact the WhatsApp number given below and send a message to the Gmail ID that is also given. Try to call as early as possible to avoid rush and disappointment. Because in Namakkal, we had to decline a lot of people who wanted to attend the event. Once again, I thank you for supporting Be Rich. Good evening and welcome back to Be Rich. Howard Marks writes regular memos, and he's recently written a memo on the impact of debt. Why has he done so? I think primarily because interest rates have stayed higher than longer than what the market expected. And he has been all the time saying that the era of low interest rates are over. In fact, he said once this inflation dies down, the interest rates will settle between 2 and 4 instead of between 0 and 2. So why has he timed this article? I have not read this memo, but Sashwath has read it. So Sashwath is going to discuss the salient points. And why has he timed it? Because I think a lot of debt-laden American companies are struggling, or even globally there is a lot of problem because of debt. Recently I read somewhere that Everglande's debt, which is especially the foreign bondholders, had not read the Chinese law properly, and their entire debt holding can be written off to zero by the Communist Party. So, and only the Chinese bondholders will be paid by the properties that are seized. In that case, Howard Marks had lent money, but he had lent money against two particular properties, one in Hong Kong and one in China, which he could seize directly. And here I have seen even in India, he's lent to companies which are in distress against particular securities. And he's a master of distress debt. And so he must know a thing or two about what is happening there. I'm sure the memo is about what damage this debt is doing, especially when interest rates are high. And like Charlie Munger pointed out before he passed away, that this year end interest rates are going to be reset on commercial real estate, and commercial real estate bondholders, that is people who own commercial real estate, will be in serious trouble as property values plummet, tenants don't come, and their bondholders must also take a haircut. Anyway, what is Marx talking about? We'll find out from Sashwath. Sashwath, up to you.
Okay, before we discuss it, I want to go through the points, after which we can open it up for discussion. So, Howard Marks's memo, published on the 8th of May 2024, is titled The Impact of Debt. He opens off the memo by saying there are 140 businesses in Japan, known as Shinise, that have been operating for over 500 years, and some of them claim been operating for over 1,000 years. He says that these companies have survived multiple emperors, some of them tyrants. They have survived wars, they've survived earthquakes, they've survived tsunamis and depressions and famines. And he says that these companies have a secret. The secret, or the common thread between these companies, is that they hold tons of cash and have no debt. These companies continue to operate today, and you can even find them online if you search for them. All else being equal, people and companies in debt are more likely to run into trouble, is how Howard Marks starts off this memo. He tells us that the presence of debt creates the possibility for default, foreclosure, or bankruptcy. People and companies in debt are more likely to run into trouble. Presence of debt creates the possibility for foreclosure, bankruptcy, or even having their assets seized. And when Howard Marks talks about a man or a company or enterprise with debt versus one that does not have debt, he says that you're more likely to run into trouble if you have debt. Then he goes on to ask the question, is all debt bad? Then we know that all debt is not bad. We don't take extreme positions on this channel. And Howard Marks himself says that no, not all debt is bad. However, he says that the amount of debt which is suitable for an enterprise are based on two facets. One, the size of the overall enterprise. Two, the potential volatility and profitability earnings, as well as the asset value of the enterprise. Debt reduces the ability for you to deal with volatility. He says that as debt increases, you narrow the range of outcomes which you can endure. So he says that with the high level of debt, you will be able to survive only the tamest of conditions, in either in life or with your business. And he says with a low level of debt, you can survive in almost any situation. And the kind of situations he talks about are like we discussed above, which is war, poverty, divorce for personal reasons, and let's say your children going to have to be educated. Suppose there's new government policy if you're a company, or even depressions, recessions. All these volatile situations can be dealt with when you have low debt or no debt. And he says the more stable an asset is, the safer leverage is to use on that asset. Although he doesn't outright recommend using leverage, we'll see further on. But he says that if you are going to use leverage, then the safer the asset is, the more consistent the asset is, the better your chances are. But he goes on to say that in 2008, he put out a memo saying that leverage plus volatility equals dynamite. This was a very popular memo of his. And he talks about how when you have volatility mixing with leverage, you basically have the recipe for TNT. He says the reasons for debt. Why would someone choose to use debt? He says that that's to increase capital efficiency. Debt capital is usually cheap relative to the expected equity returns, thus the imputed cost of equity capital, which is basically a nicer way of saying that the returns to be made from whatever venture you're getting into, debt, when financed at a low cost, is probably cheaper than the returns you're going to make. And this is the ideal scenario for a debt holder. The more debt capital you use, the more assets you can own, and the more assets you own, and suppose they're profitable, the greater profits you make on these assets. This is the ideal scenario for a debt holder. However, the flip side is also true. The more you lose when you lose. And there's another asymmetric aspect to this, which is the risk of ruin. He says that to service debt during downturns, the more leverage you carry, the less likely you are to do so, which means that the more likely that you are to get into a state of ruin. And there is no coming back from a state of ruin. Once your credit lines are busted or exploded, there's no point even looking for credit, because no one is ever going to touch you even with a 10-foot pole. This is the nature of the financial market. Investors and capital allocators do not account for tail end risk, which almost always leads to an overuse of leverage. What do I mean by tail end risk? I mean, suppose the COVID-19 impact which happened, or suppose the 2008 financial crisis. You have many different tail end events which you cannot account for, which becomes a heavy burden on your leveraged portfolio. And you do not expect for this in good times, because most people have financial amnesia where people don't seem to remember past events. And it's almost like playing Russian roulette, where the number of barrels are not 6, but almost thousands of barrels, because every day you stare at the end of the barrel, and most of these barrels are empty. However, there is one bullet which will end up shooting at some point. And most people, after a few successful tries, end up forgetting that there's a barrel. And this is an insight derived from Nassim Nicholas Taleb, who uses this insight in Fooled by Randomness. And then we finally get to the point that when you play Russian roulette long enough, the bullet is so infrequent that people forget the existence of the bullet. And once it strikes, you're done for. You can never play the game again. And attitudes towards debt are cyclical. In good times, asset prices rise, investment returns are positive, leverage has paid off, and investors view leverage as benign. Therefore, favorable aspects of leverage are well recognized. Negative potential is overlooked. Lenders become more willing to provide leverage because the borrowers are not defaulting as of yet, and regulations become more relaxed given pressure from financial groups. When events turn negative, which they often do as the pendulum swings the other way. Hey guys, I'm going to quickly interrupt this video to announce that we have successfully launched our Substack, where we talk about companies, US markets, European markets, and Japan as well. And these insights are going to be delivered straight to you to your email, as well as the Substack app. We hope you go check it out. The link is moatinvesting.substack.com. The link will be on the screen right here and also in the description. Thank you for checking it out. Leverage is penalized heavily, lending stops, and borrowers are asked, even borrowers who are in good stead, are asked to pay back their loans in bad times, and they're forced to liquidate on assets which are otherwise a great bet. There's a famous banker named John Mills in Manchester who in 1865 said that as a rule, panics do not destroy capital. They merely reveal the extent to which it has been previously destroyed by taking an excess of leverage during good times. Finally, Howard Marks says to use debt prudently is very difficult. He says if you're doing something novel, unproven, risky, volatile, potentially life-threatening, do not seek to maximize returns using leverage. He says err on the side of caution. That is, try to be safer rather than sorry. And he says Warren Buffett has continuously said that the key to survival is a margin of safety. And he closes with the quote, saying that there are old investors, there are bold investors, but there are no old and bold investors. What do you have to say about this memo?
There are several things I would like to point out. The first thing is nobody is immune from bankruptcy. Dhirubhai Ambani was the richest man in India, personally. Not as much as the Tatas, but he was personally the wealthiest man. And one of his sons, who inherited 40% of his empire, went belly up and had to say that I have no money in court. If you look at consumer empire, Vittal Malaya built one of India's largest consumer empires. He owned everything from Cadbury's to Hest Medicine, to Hest, the medicine company, to liquor, to sauce and squash juices, everything. His son made sure everything went bankrupt in 2 rounds. In India, the most common form of leverage is housing loans. And this is true everywhere else. There was a time between 2003 and 2012, you could just take a housing loan and rent the house, pay the rent, wait for it to go up and sell. By 2012, the number of house supplies had gone too much, prices went up too much. Most people are so indebted they'll keep paying for their life. Every half a point, 1 point increases the number of years you have to pay the loan exponentially. A 3% increase means the number of years can actually double or triple. And Indian banks have real estate as security, which is fancifully valued. When it comes to auctioning, they find out that this does not have the value that they hoped they had. Indian banks are still not very comfortable of bringing things at value. That is, bringing things into auction and forcing an auction to get the money back. The other idea is gold loan companies. They give more than the sanctioned value as loan. And when they come for auction, the money is not fully recovered. That's how India Infoline's gold loan division got caught with RBI, because they gave more than what they were supposed to give. Debt is a huge problem. Debt for investment is a double-edged knife. Like now Anil Agarwal is finding it out in Vedanta. He is now the third big guy who is in serious trouble. So, except perhaps for the Tatas and the Kumar Mangalam Birla group, I do not see anybody who has got into huge debt get out of debt. You need to have huge resources. In card games, you have something called show. So basically in blackjack or something like that, you have to show. When the banker says show, you have to show the money. If you cannot show up the cash, you are bankrupt. And that's exactly what the banker in 1865 said. And the time the banker asks you to show is when you do not have the money. Futures and options are also a form of leverage. And that is what is happening in the Indian stock market today. And the retail, who has no idea of what they are doing, have got into F&O, futures and options, and are bleeding. So leverage is as old as mankind, and people think that they can get away with this. But when they get into serious trouble, we should remember what Irving Fisher said. The value of debt remains same. The banker is going to extract everything, and debt continues to grow as the value of asset continues to fall. That is, if you think and you have a loan of 50 rupees and your asset is 100 rupees, everybody is happy. But the moment it goes below 50, suppose it goes to 40, your debt is 60. Not the 50 you have to pay back, plus the 10 bucks default in the fall in the value of asset. This was even further discovered by a Keynesian economist called Hyman Minsky. And there is a movement, unless you liquidate, you cannot pay the debt, which is called the Minsky movement. That is, he classifies different types of borrowers. And finally, a borrower who has to borrow to pay back old debt is the Minsky movement. And in personal finance, I can see this daily happening, where kids are now borrowing in finance apps. That is, they think they can borrow 300, pay 500 in a week, and they have nothing, it's nothing much, it's only 200. But the amount of interest they are paying is 4 or 5 times capital if you analyze it. So people really use bias and heuristics to simplify things by saying it's only 200 without calculating the rate at which they borrow, and they get into serious trouble. I have seen this many times. So this is the whole range, from the Ambanis to the guy who does not have money, who borrows on the app. Leverage is the one and the same. It leads to nothing but ruin.
I have a friend who I recently was talking to, who wanted to, because she finally got some work after college. I finally graduated. She also graduated. She finally got a job, and she needed to upgrade her laptop for the job because of the computational activities which she needed to do for it. So while I was talking to her, she was telling me that she's going to buy a laptop on EMI. She has a good salary package. She has enough financial means to afford a laptop, but she said, what's the harm in getting a no-cost EMI and split the payment over 3 months? Then she has more room to move around her finances then. It makes sense in theory because you're not paying any interest on the money you're going to borrow. However, instinctively, I understood that there is volatility involved in life. Suppose in 2 months you have some expense, or suppose you have to do something else with the money. You always have these scenarios, and it's difficult to predict these scenarios. And suppose you want to jump jobs in 2 months, then you still have this debt overhanging, and it becomes a very difficult prospect for you to pay off this debt. Better off to pay off the cost immediately and be free of any financial burden down the line. What do you have to say about
I
this?
think I agree. When you buy goods, you better have the money. Don't buy things on EMIs. And since I had to end with a Buffett quote, if you buy things that you don't need today, soon you'll be selling things that you need tomorrow.
Right.
And I have seen this many a time in life.
Right. So, finally, just to sum up what we've talked about today, please beware of what and how you borrow. Please, when you're investing, definitely look at how much debt a company has. It is not all right for a company to have more debt than it does have assets. That means the company is sick, and most of the equity is coming from borrowing rather than through retained profits or even through capital infused through selling stocks. You need to keep in mind that the more debt a company has, the greater the risk of default when times are bad. And when times turn bad, which they eventually will, because the market acts in a cycle in booms and busts, like George Soros, Howard Marks, and other exceptional investors say, you need to make sure that the company which you have or which you are owning is one which can survive and weather the storm even when their profits fall by 10-15%. And that is the kind of company you should be looking for. And that is the kind of company Warren Buffett looks at and we look at. And that's all I have to say for it.
Thank you for watching Be Rich. If you like this video, hit the like button, subscribe to our channel, turn on the bell notification. If you have already done so, send this video to your friends and relatives and have them take a look. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.